Okay, let's just get right into it. ETF, index fund, mutual fund. You hear these terms thrown around all the time, right? And honestly, it can sound super complicated, like you need a finance degree just to understand the difference. Well, I promise you by the end of this, it's all gonna click. It's actually way simpler than you think. So, here's what we're gonna do. First, we'll tackle the confusion head on. Then we'll have that big aha moment with this idea I call strategy versus wrapper. After that, we'll break down what each term really means, help you figure out which one is right for you, and wrap it all up with the one key takeaway that makes it all stick. Let's do it. All right, first things first, let's talk about why this is so confusing to begin with. The problem really just starts with the way we talk about this stuff. And there it is. That's the core of the problem. We treat these terms like they're three different options on a menu, and you have to pick the best one. But that's totally the wrong way to look at it. And that one little misunderstanding is what makes everything else feel so complicated. Okay, so now for that aha moment. Seriously, if you get this one idea, the rest of this is going to be a piece of cake. This completely reframes how you think about these terms. So here it is, the big secret. An index fund isn't a thing you buy. It's an idea, it's a strategy, a philosophy for investing. ETFs and mutual funds, on the other hand, those are the actual packages, the containers or wrappers that you use to hold that strategy. So one is the what you're investing in, and the other two are how you invest in it. And that is the mental shift that changes the whole game. You have to stop thinking of them as rivals. They're not. They're partners. An index fund strategy has to live inside a container, and that container is either an ETF or a mutual fund. Okay, so let's zoom in on that strategy for a minute. What does it actually mean to follow an index fund strategy? Well, the idea is actually beautiful in its simplicity. It's about owning a tiny piece of the whole market instead of trying to find that one magic needle in the haystack. In other words, investing in an index fund is basically saying, you know what? I'm not going to pretend I can predict the future. I'm just going to own a tiny sliver of all the big companies and trust that as the overall economy grows, my investment will grow with it. It's simple and powerful. And what's so cool about this is how, well, lazy it is. In a good way. It's totally passive. The fund just follows a simple rulebook. If a company is in the S&P 500, the fund buys it. If it leaves, the fund sells it. That's it. There are no expensive managers making gut decisions, and that's exactly why the fees are usually so much lower. And I'm just going to say this one more time because it really is the key to everything. That strategy, the index fund, it has to be put inside a container. And that container, that wrapper, is always going to be either an ETF or a mutual fund. All right, so let's move on to those wrappers. Now that we understand the strategy, let's look at the two different packages you can buy it in. First up, you've got the ETF, which stands for Exchange Traded Fund. The easiest way to think about this is that it behaves just like a stock. You can buy it at 9:35 in the morning, you can sell it at 3:15 in the afternoon. The price is moving all day long. This flexibility is why ETFs have become so incredibly popular for people who invest on their own. And then you have the classic mutual fund. This one's a little more structured. Instead of trading all day, all the buying and selling happens just once a day, after the market closes. And that structure is actually a feature, not a bug. It makes it super easy to just automate your investing every single month, which is why you see them all the time inside workplace 401k plans. So this table really lays it all out. The ETF is your flexible wrapper. Think hands-on investing and an app on your phone. The mutual fund is your structured wrapper. Think set it and forget it automation, perfect for a retirement account you don't want to mess with. Okay, so that all leads to the big question, right? Which wrapper should you actually pick for your index fund strategy? Here's the simple way to think about it. If you're investing by yourself in a brokerage account, like a Vanguard or a Fidelity account, and you value that flexibility to trade whenever you want, the ETF wrapper is probably your best bet. But if most of your investing happens in your 401k, or if you just want the absolute easiest way to automatically invest every month, the mutual fund wrapper is perfectly designed for that. And this is just such an important piece of advice. Don't get bogged down trying to find the absolute technically perfect option. The best choice is whatever is simplest for you, the one you understand so well that you can just stick with it for years and years without overthinking it. Consistency is what really wins. All right, that brings us to the final point. If you forget everything else we talked about today, please just remember this one thing. This is the key. That's it. That is the whole ballgame. An index fund is the what, An ETF or a mutual fund is the how, strategy versus wrapper.
And I'm telling you, the moment that distinction really clicks in your brain, it's like a light bulb goes off. The fog lifts, and this whole world of investing just stops feeling so intimidating.
Now, I know that was a lot of information, so to make it super easy for you, I've put everything we just covered into a clean, visual, one-page summary on a Notion page. It's totally free. You can read it, you can duplicate it for your own notes, whatever you want. The link for that is right down in the description. And finally, if this explainer was helpful for you and you want more lessons that break down complex topics and make them simple, please go ahead and hit that subscribe button. It's the best way to make sure you don't miss the next one. Thanks so much for watching.